But we'll start our coverage about surviving a recession by looking back to the 90s, then forward to the latest information that's tipping the economic pendulum right now. Edward Boyd reports.
The 19th of October 1987, almost 36 years ago, marked the Black Monday stock market crash.
I can't get you out of these stocks because there's no buyers. The market at the moment's down 312 points. There's no sign of any recovery. It's a worldwide financial crisis, and Sydney has not been immune. You're seeing living history here, mate.
The All Ordinaries lost 25% in value in a single trading session, wiping $65 billion from Aussie shares. It was a warning sign for a looming recession. Less than 3 years later, ahead of the March 1990 election, Prime Minister Bob Hawke declared everything was rosy. That was despite inflation jumping to 8.6% in the March quarter and the unemployment rate rising to 6.2%.
There is no need to fear a recession in any sense.
But 5 months after winning the election, Australia had entered a deep recession, with economic growth in the September quarter falling 1.6%. This forced Treasurer Paul Keating to concede with his famous quote.
Australia's in a recession. This is a recession that Australia had to have.
It's worth remembering that the 1990s recession didn't happen until almost 4 years after the catastrophic share market collapse that ultimately triggered it. The Australian public backed Paul Keating. He won the 1993 election before losing in 1996 to John Howard. It's worth observing that right now, Australia is coming up to 3.5 years after the start of the COVID pandemic, which also triggered a sharp downturn in the stock market. And the public is backing Anthony Albanese and Treasurer Jim Chalmers. The latest news poll in the Australian newspaper has Labor leading the coalition on a two-party preferred basis, 55 to 45. Here's Chalmers speaking last week after the economy grew by just 0.2% in the first quarter.
Well, I'm not going to make predictions about the June quarter. I think it's really clear that a combination of higher interest rates, cost of living pressures and global uncertainty is weighing on growth in our economy, and we anticipated that in the budget. The Treasury forecasts reflect that, and what we're seeing today is quite consistent with the Treasury forecasts for the economy.
The Reserve Bank surprised the market by raising interest rates this month to 4.1%, and Governor Lowe has said more rate rises will be required to bring inflation down. The problem for the economic outlook is that the RBA is raising rates at a time when the economy is noticeably slowing. The narrow path to avoid a recession or a sharp downturn is getting narrower.
If we had not tightened monetary policy, the cost of living would be higher for longer. This would hurt all Australians and the functioning of our economy. This would ultimately require even higher interest rates to get inflation to come back down again and more unemployment.
Governor Lowe flagged another problem for our economy, record low levels of productivity growth. And that places the problem of rising interest rates back at the feet of government. The annual rate of productivity growth in the March quarter, which is measured as GDP per hours worked, slumped to negative 4.6%.
At the productivity reform agenda, we really need to focus on that, because if we're going to have nominal wage growth of 3.5% to 4%, then we need to have productivity growth of 1% a year. We're not generating that.
And onto that, monthly inflation for April came in at 6.8%, lower than the 8.4% reported for December, but still way too high for the Reserve Bank. Economists have changed their forecast for Australia. Many now say the chance of a recession this year is increasing.
So prices are still very sticky. I think they're past the peak, but they're still not really doing what the Reserve Bank wants. And to get it there, I think the Reserve Bank is saying, well, if we have to have a mild recession, we'll have one.
A classic warning sign of a coming recession is the inverted yield curve. It occurs when the yield on short-term bonds, like one-year government bonds, is higher than the yield on longer-term bonds, such as three-year bonds. So investors believe that while interest rates will rise in the short term, they expect these higher interest rates will cause the economy to slow down and force the Reserve Bank to cut rates in the future. And that's a view shared by money markets and economists right now.
The Fed's been more aggressive. It's been consistently on this anti-inflation tack since late 21. Whereas the RBA, we had that unfortunate period of calendar guidance, and then we had the stop-start interest rate increases, the sort of shifts in rhetoric from Philip Lowe last year. And it's only now that he's sort of reasserted himself as an inflation hawk.
Another sign of recession, according to Alan Oster, is a little-known statistic: forward orders by companies. And that light is flashing right now as well.
Forward orders that are negative, but only during major recessions like 91, GFC and COVID. Outside of that, we haven't had negative forward orders.
The government still hopes a recession can be avoided.
We still think that we can tread that narrow path to avoid a recession, and that's what all of our strategies are aimed at.
The recent ruling by the Fair Work Commission to increase the minimum wage by 5.75% from the 1st of July will add to the inflationary pressures in the economy and push up costs for business. And as NAB's Alan Oster has already said, that could result in a 50-50 chance of a recession.
But what it tells you is that we now have an economy where the outlook is quite vulnerable to any sort of adverse shock, whether that's something that comes from offshore, whether it's something that comes from Australia. You know, it's not going to take much for that path to basically be as narrow as a piece of string.